Hello, and welcome to Advanced Futures Intelligence Introductory Futures course, Futures 101. This tutorial is designed to give investors who are new to futures a basic understanding of what futures contracts are and how they can be used in an investment portfolio. So let's get started. So what exactly are futures contracts? Futures contracts are known as derivatives because they derive their value from an underlying asset. Some common examples of futures include energy futures, crude oil, natural gas, heating oil, financial futures such as indexes, S&P, Dow Jones, bonds, things like that, currencies. Then you have precious metals, gold, silver, platinum, palladium. And of course you have grains such as soybeans, corn, and wheat. Now, another key feature of futures contracts is called standardization. And this means that various contracts are standardized in terms of quantity, quality, delivery date, and delivery location. The only variable is price, which is determined by the market. So an example of standardization would be 5,000 bushels of corn make one contract, or 125,000 euros make one contract, or 1,000 barrels of oil make one contract. Now, futures traders commonly use leverage, and that's the use of a small deposit to control a larger asset. And they use this to trade futures, and it's very similar to when you place a deposit on when you're buying a property or when you're using leverage to trade stocks. Now, since futures contracts use leverage, people who trade in these products are able to deposit small amounts of capital to control full-size contracts. If the markets move in their favor, futures traders can make a lot of money in a very short space of time. But leverage does work both ways. If the market moves against the trader, losses can add up very quickly. So let's talk about this leverage a little bit more, and I want to go through and explain exactly how it works. Now, the basic concept of leverage is the same in futures as it is with stocks. Futures traders, though, make a lot more use of leverage than a stock trader ever could. With stocks, most leverage is 2 to 1 or slightly less, meaning if you wanted to control $10,000 worth of stock, you'd need to put up about $5,000 in collateral. Futures contracts require a much smaller deposit to control a position. So for example, gold, which is a very popular futures contract, requires about $11,500 to control 100 ounces of gold. Now that 100 ounces of gold is worth over $175,000. And that means that the deposit is about 6.5% of the contract value. So when it comes to leverage, use it wisely. It can help you make a lot of money, but it can also drain an account very quickly. We're going to go over some strategies that you can use to help use leverage wisely a little bit later in this presentation. So let's take a look at some very basic futures terminology. Futures trading definitely has its own lingo, and you're going to hear a lot of different terms coming your way. However, these are going to be the most common ones. First one would be a long position or going long, and this is simply when a futures trader expects prices to rise, and so that futures trader is buying that contract, expecting to sell it at a higher price in the future. On the flip side, you can also take a short position or go short on a futures contract. And that's when you expect the prices to fall. And so what you're going to do is sell today and buy that back at a lower price in the future. And the difference is your profit. Again, margin, which is good faith deposit that's put up by a futures trader to control a futures contract. Some futures brokers will allow smaller margins called day margins for traders who exit their positions before the close of the business day. Now, profits are added to your trader's margin account, and losses are subtracted to your trader's margin account. Which brings us to the lovely margin call, or should I say the dreaded margin call. And this is what happens when a trader holds a losing position and the margin deposit falls below a certain level called the maintenance margin. The broker will then issue a margin call where the trader needs to add more money to the account or exit the position. Now, it's generally accepted as bad trading strategy to add money when you receive a margin call. Traders are typically going to exit the position. There's also a bull market, which is a market where prices are rising, and a bear market, which is a market where prices are falling. So let's take a quick look at a few of these things. Here we have an example of an uptrend, and that's covered by the green line. You can see that prices are steadily moving up. This is a gold chart. It's a 5-year gold chart, so it gives you an idea of how gold has moved over the past 5 years. Right there, we see this perfect example of what we call consolidation in the market. And you're noticing the market is moving sideways. It's not making breaks to new highs, but it's also not really collapsing to new lows. So it's kind of moving sideways in a range. Now, there are a number of chart formations in this example, and we're going to go over some of them later in the presentation. We're also going to go over the chart formations in Futures Options 101. So after you finish listening to this presentation, I'd suggest you go and you listen to Futures Options 101. So let's take a look at the various styles of trading. Now, all trading involves risk of loss, and traders do need to understand how to properly manage risk in their trading. Futures traders, though, generally fall into one of three categories. You have your day trader, and day traders tend to execute several trades on a daily basis, and the goal here is to make small gains on each trade. Now, successful day traders can make $1,000 a week or more. However, there is a catch. Only a very small percentage of people who day trade are successful. If that's what you want to do, if you want to become a really good, successful day trader, I would strongly suggest you get top quality education and training. There's also a swing trader, and swing traders tend to be short-term traders, and sometimes they'll hold positions for a few minutes, but sometimes they'll hold them for, 2, 3, 4, a few days. With the right training, swing traders can be profitable, and swing trading is probably a bit less stressful than day trading. Day trading is very fast paced, and some people find day trading very, very challenging. Swing trading can be fast paced, but it can also be a little bit slower because you give the market a little bit more breathing space, and sometimes that's what markets need. Now, of course, that brings us to the position traders. And position traders tend to hold positions for several days or weeks. And their goal is to capture and capitalize on long-term trends in the market. Now, position traders do tend to be more profitable than day traders or swing traders. However, it does take a lot of patience, a lot of strategy, and education to become successful. The bottom line is this. Any type of trading can be successful, but it does take time. It takes a lot of dedication, education, and strategy to be successful. So let's take a look at risk versus reward. And let's ask the big question. Why do traders take the risk and trade futures? The answer is very simple. The profit potential for successful traders is huge. Let's take a look at this 5-year gold chart one more time. You can see the move in gold started right about there. And we'll take a look at it to that point. Now, you can see that gold went from about $700 to about $1,700 per ounce there. Well, that move was worth over $107,000 in potential profits. So if you had been able to catch it right at the bottom and exit the position right at the top, you would have made over $107,000 in profit. Now, day traders and swing traders would have gone into this market as it's moving up, and they would have tried to take small increments of the overall gain. Now, what a position trader would have done would have been they would have established a position, and they would have tried to capture, anywhere between 60 and 80% of the value of the move. That's profit. Whenever you take a look at profit, you always have to take a look at potential risk. So here we are again with our 5-year gold chart, and this chart gives us a perfect example of the risks involved with futures trading. Now, if you felt that prices would continue to rise, you'd simply take a long position. And if you take a long position, your maximum risk is the value of the move from your entry point to zero. So, for example, if you bought gold at $1,000 per ounce, then your maximum risk would be the value from your entry point, which is $1,000, to zero. A commodity can't trade below zero, so you have a floor on your risk. So in this case, if you bought gold at $1,000 an ounce, your maximum risk in this contract would be $100,000. Now, if you felt gold prices would fall, you'd take a short position in the market. Now, in this case, your risk is theoretically unlimited because gold could rise for an indefinite amount of time. You know, but how do you protect yourself? None of us want to take big losses in our futures trading. How do you protect yourself? Experienced futures traders use what's called stop loss orders, and what this does is it allows them to limit the amount of money they could potentially lose on any particular trade. Now, placing these orders correctly is part art, part science, and it does take time to learn because with futures trading, there's an old saying: you cut your losses short and you let your winners run. So you always want to keep your losses as small as possible, and you want to squeeze as much as you can out of your profits. Now, there are literally dozens of futures markets that you could trade. And how do you choose the best market to trade? Well, there's no best market. It all depends on what a trader wants. Now, there are a few markets that do tend to attract more attention than others, and let's take a look at some of them. The first one is a big one, and most people have heard about this because it's spoken about all the time on the financial news, and that would be index futures. You hear about the S&P futures in pre-market trading and the Dow futures in pre-market trading and things like that. These are what index futures are, and especially the E-mini S&P. Index futures are among the most common futures markets used by traders today. They're very liquid and offer excellent entry and exit points. But these markets are very fast moving and can be a real challenge to trade for non institutional traders. If you want to wade into this section of the futures market, I strongly suggest you make sure you study this market very well and take some serious steps to educate yourself. Another really common market for traders to venture into would be bond futures, particularly the 10 and the 30-year bonds, which are very popular markets for all types of traders: day traders, swing traders, and position traders. They're very liquid, and again, they offer really good entry and exit points, but they do tend to trend more evenly than a lot of other markets. So you'll have bonds tending to, move up more gradually or move down more gradually than the volatility that you'll see in some of the other markets. And that's the nature of the beast. However, bonds can become very volatile as well. So you always have to make sure that you educate yourself very well when you're going to go and trade bonds. So bonds can be very fast moving, or they could just inch along. And some traders actually do feel that bonds are easier to successfully trade than most other markets. But again, regardless of that perception or any other perception, success in bond trading comes from strategy, patience, education, and understanding what drives the market. Another very common futures market to trade would be currency futures. Now, currency futures, and especially the euro, are very common with futures traders. The spreads in these markets are very tight, and liquidity, especially in the euro, is very good. Now, some traders will focus exclusively on currency futures, and that's because they believe that they are the strongest barometer for other markets. Now, like all futures contracts, success comes from strategy, skill, education, and execution. You have to have all four in place in order to successfully trade any market. Now, these are all what we call financial futures. There are hard assets or commodity futures. So, for example, precious metals, primarily gold, and gold is the primary market for precious metals traders, with other precious metals markets following. Now, gold has gained in popularity as global government debt levels have gone up, 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 and up, along with a growing number of people who feel that they need a hedge against adverse moves in other asset classes like real estate or paper currencies. So gold futures offer a lot of liquidity and very, very strong profit potential, but gold and other precious metals are known for wild swings in the market. So you have to have really strong risk management skills if you're going to go into precious metals. Now, those risk management skills will go a long way to boosting your chances of success. There's also grains futures. Food products, as I'm quite sure we all know, just like gold and oil and everything else, have seen a steady rise in the past decade, and it probably will continue to see that steady rise. And that makes grains futures a lot more popular for traders looking for a field to specialize in. Grains do tend to be very liquid, but they can be prone to a lot of price volatility as well. Just like precious metals, make sure you understand some of the more advanced risk management strategies and you understand what moves this market before you venture into this market. The last one we're going to take a look at would be the energy futures. Now, crude oil is by far the best known energy futures contract, but you also have natural gas and unleaded gasoline and heating oil, things like that. Crude oil, though, is by far the most popular, and it's very popular among commodities traders. Now, market sentiment is a huge driver of the energy complex, and of course, that's followed by supply and demand, and that tends to have more of an impact on all physical commodities than financial commodities. Now, traders who understand how the energy complex works and how to properly manage their risk and capitalize on the opportunities can actually be very successful in trading the energy complex. Now, of course, we've mentioned, I've touched on it over and over again, that you have to have strategy, you have to have execution, you have to have all these key things. And that brings us to what we call a trading plan. And a trading plan is a document that you have that is going to act as a guide. It's your business plan as a trader. And you have to have one if you really plan on being successful. A clearly defined, well-planned trading plan can actually make the difference between success and failure in futures trading. Here's a list of things that you want to include and things you want to avoid as you go through and develop your personal trading plan. First and foremost, be realistic. Trading is a skill, and it does take time to develop that skill. Rome was not built in a day, so make sure you set incremental goals for yourself. Another thing, be very specific. Set very specific goals for yourself and for your trading. Set your profit objectives for each trade. Set your loss tolerance for each trade, and make sure you outline how much capital is going to be at risk overall and with every specific trade. Be focused. Make sure you carefully watch each trade that you execute. Every trade is an opportunity for you to learn and improve your trading skills regardless of the outcome. Be prepared for losses. The only guarantee in trading is that you're going to have some winning trades and you're going to have some losing trades. You have to learn to manage both outcomes. Another one is that we strongly suggest is to write out your trading plan and your trading strategy. Your trading plan is your guiding document, while your trading strategy is the how-to manual. It's your vehicle. Write both of these things down in detail. The last big thing that comes to mind when you're writing your trading plan would be conquer your fears. Trading can be a lot of fun and it can be very lucrative. Don't be afraid to learn new strategies and techniques. I would suggest you jump at every opportunity you have to learn. And of course, we can't just talk about that. We have to talk about things you have to keep your eyes open for, and you have to watch out for these things. First and foremost, avoid get-rich-quick schemes. The trading world is absolutely full of them, and when someone tells you that they have a quick and easy method to trade the market, keep moving. There is no such thing in existence today, and I doubt it will ever come into existence. Avoid getting locked into one strategy or one market. Now, futures are constantly changing, and diversifying your markets and your strategies maximizes your chances of overall success both in the short and in the long term. Last key point, avoid ignorance. Successful traders are very well educated traders. Maximize every chance of success by expanding your education and expand your knowledge base. So moving on. Of course, execution is absolutely critical because timing is absolutely critical in the futures market. So when you are when you're building this trading career, you have to make sure you choose the right broker. Now, choosing the right broker can actually have a big impact on your trading success. Some traders are going to need better platforms, some traders are going to need market informations, and other traders, they will only need execution. So here's a quick checklist for you to go through and ask when you're selecting a broker. Do you have more than one execution platform available for use? Now, industry leading brokers will have several, two, three, four, five platforms that you can use depending on your needs. How flexible are your commissions? It's very true. Commissions do play a role in overall success, but make sure you're getting the best value versus just going for the lowest price. Futures commissions are very competitive, and you'll have some firms with a larger range of services than others. And so sometimes for $2 or $3 more, it might actually make a lot of sense depending on your situation and what you need. The next key point is how experienced is the staff. The volatile nature of the futures markets can make a knowledgeable, well-informed broker worth his or her weight in gold. The trick, of course, is finding those very few brokers who are able to add real value and profits to your trading. The last thing you want to take a look at when you're looking for a broker is, what about personalized service? Some of the strategies that you're going to use and you're going to learn will require a conversation with a broker, and you need to make sure that when you need someone and when you make that phone call, that somebody's on the other end of the phone who can talk to you and who knows exactly what you're talking about and who can walk you through so that you don't make any mistakes that may end up costing you. Let's summarize things. Let's take a look at the 6 keys to successful trading. So first and foremost, futures trading can be very profitable, but futures trading does come with a risk of loss. You always have to bear that in mind. There's a lot of money to be made in futures trading, but if you don't approach it properly, there's a lot of risk and you can lose money just as quickly. So always make sure you approach the markets well. Always make sure you're well educated. Always make sure you're well informed. Make sure you have that strategy. Make sure you have the execution. Make sure you give yourself all the tools that you need in order to become a successful trader. Point number 2. By learning proper risk management techniques, a trader can improve their chances of long-term success. You are guaranteed to have trades that lose money. There's nothing you can do about that. What you have to do is find a way to to walk that fine line. Small losses, big gains. Small losses, big gains. That's the way it needs to be. Point 3. The major keys to successful trading are strategy, discipline, education, execution, and trade management. Make sure you have all of those in place so that you can maximize your chances of success. Point number 4, there are dozens of different kinds of futures contracts, and all of them can be traded successfully. So look for the ones that you are most interested in and learn how to trade those markets. Number 5, for new traders, it may be easier to stick with the more common markets that we discussed earlier in this presentation. And number 6, to be successful, traders need to educate themselves and make sure they have the tools and education that they need to succeed. So again, I'd like to thank you for listening to our presentation of Futures 101. Again, if you have any questions, feel free to contact us at Advanced Futures Intelligence by sending an email to questions@Advanced Futures Intelligence, and we will do our best to get you those answers as quickly as possible. Again, we strongly suggest that you follow this up with Futures Options 101 and then view Trader Psychology 101. So once again, happy trading and profitable trading. Have a great day.